Hello, welcome everyone. So, hope you're enjoying the webinar. And yeah, we're going to talk today about buying your competitor, doing deals. I think, lots of people don't really think about mergers and acquisitions when it comes to running businesses or being a founder of a business, but actually it's a really powerful tool to solve a number of problems. And again, I think most people look at it quite one-dimensionally in terms of being a solution for growth. And of course, it can be used in lots of other areas. So I have to point out, first of all, by the way, all the way through this, if you want to chuck questions in the chat, just fire away. If you want to use the Q&A, you can type in the Q&A as well. Happy to answer any questions. I know the obvious first question is the backdrop. It's not a Zoom filter. It's actually a real background. So yeah, there's a beautiful mountain and a lake there. And funnily enough, I just did a 2-day M&A kind of boot camp thing from a hotel room, and the background was terrible. It was like the corner of a wall or whatever. So so you've definitely got the best Zoom background for this week. So anyway, I think the first thing to kick off with really is somebody saying there's no sound. Can you hear me okay? Can everybody else hear me okay? Yeah, I'm getting thumbs up from other people. So Sanjay, maybe you have some issue with your sound, your audio settings. If you go down to, I think it's actually the mute button. If you click on the mute button, I think it gives you audio settings, or it might be in the three little dots over the other side. So yeah, hopefully everyone else can hear. So yeah, so hopefully you just need to get your particular one fixed. So look, when we think about becoming entrepreneurs, we always think about startups, or most people think about startups. And obviously, the reason people start businesses is that they're looking to, create freedom for themselves, whether that be financial freedom or kind of time freedom, being master of their own destiny. And then they start the business and it takes away all of their time and all of their money. So the financial freedom goes out the window and the time freedom goes out the window. They can't take a vacation from this thing that they've created, and it becomes really, really difficult for them. So I was definitely a startup entrepreneur from a young age, and I know Callum was, and basically, started a number of different ventures as a sort of teenager and into my early 20s. And basically, when you're running a business, you can control three things around organic growth. One of them is your team, how you manage your team, the people you hire, the culture that you build within the company. The second one is your marketing, how you go out and acquire inquiries, how you get people to put their hand up and say they're interested in doing business with you. And then there's sales, how you convert those inquiries into paying customers. And so most of us are playing with these three levers at some level to grow our business. Now, I was fortunate enough to have a telecoms company in the 1990s, and telecoms was just a really weird industry because it went through this explosive growth period. So basically, there was a time when nobody had a mobile phone, and now we have a time where everybody has a mobile phone, even my kids, and they're 9 and 11 years old. So, we've gone through in that period of time, zero to absolute market saturation. And so the industry went through this interesting period of explosive growth in the number of companies that would supply people with telecommunications, because everyone you met was a customer. I mean, I used to go to networking meetings with 20, 30, 40 people in the room. Every single one of those people could be a potential customer. So it was like, shooting fish in a barrel, to use that analogy. And then basically the industry started to reach saturation. Pretty soon, everybody had a phone. And back then, if you changed suppliers, you had to change numbers. The numbers were allocated to the different network providers. So if you changed from one to the other, you lost your number. And also you were in contract. So you normally had to sign a 1-year contract. So when you moved to another provider, you had to wait until the expiry date of one contract before you could move to another one. And so consequently, instead of everybody being a potential customer, almost nobody was a customer because they were either in contract or desperately needed to keep their number. And so the industry kind of started to really slow down in terms of its organic growth. And so then the only way to grow a telecoms company at this point in history was to go and buy one of your competitors, because they already had the customers that were in contract that you could just bring over to your service provider or company, and start to build those customers. Now, me as an entrepreneur, I'd never thought about buying a business, simply because I didn't have any money, or we were making money, but basically every month it was a kind of juggling act to survive until the next month. And you would, have this choice of paying your credit card bill or paying your staff. Giving this money to somebody to buy their company just wasn't really an option that we considered. And then the other aspect was just, I didn't know what I was talking about. I had no idea how you would even go about buying a business. It was completely alien and unusual to me. So basically, people were ringing me up all the time saying, "Can we buy your business?" And me being a perpetual learner, every day as a school day, I would agree to have those meetings just to see what they were about. And also, beats actually working, doesn't it? If you can distract yourself with meetings. So I used to have all these meetings with these people that would come in and give me their presentation on why I should sell my business to them. And then it dawned on me that, you know what, these people don't know what they're talking about either, and they don't have any money either. So here I am sitting on the receiving end of these approaches, whereas in fact I could be sitting on the other side of this desk. I could be the one presenting this idea. And so by listening to a number of these pitches, you kind of understand what the things were that were good and what the things were that were bad, what, the things that turned you on, the things that turned you off. And then basically I just went and tried those things on other people. So when I went to networking meetings, instead of looking for people who used mobile phones, I would look for people who had mobile phone businesses or fixed line businesses or broadband businesses. And then I would go to talk to them about potentially acquiring their business. Now, I still didn't have any money, so whatever way I was going to structure a deal back then, it would have to be a no money down transition. So where the buyer and the seller share the risk in the transaction. And I'll come on to that in a minute. But basically, what that meant is I needed to find somebody that was highly motivated, somebody that really needed to get out of their business. And I found a company. It was 13 years old. It had 1,000 active handsets, which was about what we would connect in a typical year. And I was able to structure a deal where I didn't put any cash in on day one, and I paid them out over a period of time. Now, for me, that was an epiphany, because we grew by a year's worth of sales in an afternoon. We picked up 13 years worth of blood, sweat, and years in an afternoon. And we didn't have to spend any money on marketing, didn't have to hire any salespeople, didn't have to invest in any of that kind of stuff. And so for me, it was just like a complete game changer that all this time I'd been running the marathon and I only needed to run the last 10 yards and they would still give me a medal. So it was a complete game changer. There was now, I remember I talked about the three levers, the team, the marketing, and the sales. There was now this fourth lever, which was go buy a competitor, go buy somebody else. Now, what's interesting, people always say, well, how do you buy a business with no money down? And my facetious answer is always start with no money and try and buy a company, because necessity is the mother of invention. But that's normally when I want the conversation to finish quite quickly. The real answer is actually just the market dynamics that are out there. So if you look at all the businesses in the world, it's like a pyramid like this. So there's some big businesses at the top, really big businesses at the top. And at the bottom, there are millions of tiny, tiny companies. And by tiny companies, like sub 2-3 million in revenue. There are, most companies fall into that that category. And then if you look at the universe of business buyers, so the universe of people that can actually buy businesses, it is the opposite. So there is one person at the bottom that can buy the millions of businesses that are doing $1 million a year of revenue. And there's tons of people at the top that can buy these extremely large ones. So basically the whole market dynamics is inverted. And so what happens is there's a few things that benefit you here. The first one is right at the bottom is a buyer's market. Now, people think they can sell their business for lots of money. The reality is they can't. If you look at business brokers, they sell 8% of the companies that list with them. And what you'll tend to find is that those are either exceptional businesses or the owner's died, something really bad has happened, and they're desperate to just get it off their books. So they take the first offer that comes along. But generally speaking, those small businesses are very, very hard to sell. And so as a consequence, the vendor is not going to get that magic $1 million that they're looking for all in cash up front. If they want to sell their business and if they want to get anywhere near a sensible valuation for it, they're going to have to work collaboratively with the buyer in order to achieve that valuation. So I call it dragging your chair to their side of the desk. So instead of creating a negotiation with each other, you solve the problem together. You sit around the same side of the table and say, how do we get you to your $1 million exit? And you plan a collaborative way to get you into the business and get them out of the business whilst not making it too risky. Because ultimately, small businesses are a very volatile asset class. If they lose a couple of staff or a couple of customers, the business can cease to exist. And so you don't want to be putting lots of hard cash into a volatile asset. I often put it to people that, would you mortgage your house and put the money into a meme coin, or a highly volatile crypto kind of investment? Some people say yes, but you really shouldn't. You shouldn't use debt to buy volatile assets. And unfortunately, this is what too many people do in the M&A world. They use leverage buyouts because they're used to the kind of real estate game where you put in a deposit, you borrow some money, you buy a house, you rent it out. Businesses are not the same. Businesses have infinite moving parts. They change all the time. They're not really assets. They're ideas that are incredibly volatile. So you can't use those same kind of asset purchase principles when it comes to buying, in imprecise or volatile streams of revenue. So basically, the first thing is it's a buyer's market. The other interesting dynamic by the way, in that two pyramids or two triangles approach that I've just described, is that as you become bigger, so as you move up the scale pyramid, there are less and less companies who look like you. So there may be millions of companies doing 1 million. There may be hundreds of thousands doing 10 million. There may be, thousands doing 20 million. There may be hundreds doing 50 million, and so on. And you become more and more rare. But if you look at the buyer dynamics, the audience of potential buyers is getting bigger and bigger and bigger. So there's actually an inflection point where there are now more buyers than sellers. And that has an exponential uptick in your valuation. So very small businesses might only attract a very small multiple of their earnings. So there are lots of resources online where you can look at this and you'll see engineering companies are selling for 1.5 times their earnings. But you'll see that really large engineering firms are selling for 8 to 12 times their earnings. And you'll see that public listed engineering firms might be 24, 25 times earnings. So there's this huge delta from 1.5 times earnings to 25 times earnings as you move up that scale pyramid. So the audience of buyers is getting bigger. The risk is getting lower because with a big business, if you lose a couple of staff or a couple of customers, it's a rounding error. In a small business, it can be half the company. So there's, it's a very, very different dynamic when you start to move up that scale pyramid. But anyway, I digress. It's just an interesting idea because ultimately, buying your competitor not only solves lots of interesting problems, but it also moves you up the scale pyramid. So you're exponentially increasing the value of your business by moving up that scale pyramid. So yeah, hope that makes sense. So buying competitors is a really interesting idea, and it's very much of the moment as well. If you look at what's going on in the global economy right now, I think we're just about to have another inflation shock. We obviously had the post-COVID inflation shock, which the government did a really good job of covering up by saying CPI was 3%, when, CPI is just a list of things you don't actually buy. But if you looked at the list of things you do actually buy, you've seen a huge amount of inflation over the last few years. And now, obviously, we've got a double whammy of oil prices going up. They're artificially manipulated at the moment, and it's still around $100 a barrel, and which is roughly double where it was not long ago. And the other thing that people overlook is, most of the electricity in Europe is generated from gas, and most of the gas comes from Qatar. And actually, a lot of the fertilizer comes from Saudi and Qatar, and is the synthetic fertilizer that's made from gas. is that's made from natural gas. And so, shortage of fertilizer and spike in oil price should be incredibly inflationary. And when times are very inflationary, it tends to put pressure on business. And the first pressure tends to be on small businesses because they're already skating on a pretty fine margin. And so businesses that were previously profitable become either break even or slightly loss making. And then it just comes down to how long the crisis lasts as to how big the bloodbath is at the end of it. And so, I think there's a great opportunity if you have three companies that are breaking even, or even three companies that are losing money. Putting them together can often make one company that makes money because you can deduplicate the costs, you can find efficiencies between the companies. In fact, often it's worth consolidating two or three companies together just to rescue them, just to save them. So it's much, much easier to have those conversations when times are tough, because people are looking for a solution that doesn't involve going into some sort of bankruptcy or insolvency. So, but buying your competitors can be enormously valuable on a number of levels. So one of them is obviously the one I've just talked about, which is a kind of survival, profit improvement, revenue enhancing, basis. But there's a few things that get really overlooked as well. So the first one is succession planning. Now, you will have all heard this expression that you should work on your business instead of in your business, and this is absolutely true. But it's really hard to execute, and particularly hard to execute in a business that you started yourself. In fact, what tends to happen when you start a company is you're ingrained in every single process from day one, and then you've gradually handed them over to other people, except there's probably a bunch of them that you're still far too involved in, considering where the business has got to today. And so one of the great things with buying a competitor is that you also buy their management team. And by buying their management team, you can effectively get a team of people who are already running a business that looks like yours. It's much easier to get them to come and run a business that looks like yours. When you hire a new CEO, you effectively end up paying the CEO plus your salary. And then plus there's the handover period, plus there's getting them to understand, plus there's a little bit of a flip of the coin as to whether they're any good. And of course, that flip of the coin is with your business. So do you really want to call heads or tails on whether your business survives or not? Probably not. But if you acquire another business that comes with lots of revenue and lots of customers and a management team that can effectively take over the day-to-day operations, that frees you up to become non-executive within the business. So you can then focus on finding more deals, doing joint ventures, finding an exit partner for the business, somebody that can buy the company. So succession planning through acquisition really is a very powerful tool that you can use to get you to that working on your business instead of in it, and also having something that you can sell that doesn't rely on you. So in other words, you don't end up selling it with you in the driving seat doing all the all of the work. So the other great thing with acquisitions is it's a great way of dealing with concentration risk. So the most common concentration risk you see in businesses is client concentration. So a big percentage of your revenue is coming from one client. If you've got 80% of your revenue coming from IBM or something like that, and you lose the IBM contract, you lose most of the business. So the best way to deal with concentration is to dilute it with more customers. And the easiest way to dilute it with more customers is to acquire your competitor that has more customers, so that effectively your 80% concentration risk gets down to a sub 20% concentration risk, and then it becomes less of an issue in the valuation and sustainability of your company. So, whenever I see concentration risk, and it can sometimes be concentration risk around a supplier or an employee as well. So again, those things tend to be solvable through acquisition, so that you have a broader supplier base, a broader employee base. So you reduce that kind of concentration risk. The other one I see quite often is products or services. So I see very healthy, profitable companies go and sink $1 million into a new product development, or go and sink $1 million into a new service offering, and then have to basically treat it like a startup within their business to see if it works. And what you can do is, if you need to add that product or service, you just go and acquire the company that has that product or service. then immediately you've got their customers, because presumably you want this product or service because it's synergistic with your customers. Well, you've then got all of their customers to sell your services to, and all of their services to sell to your customers. So you create this great cross-selling opportunity, as well as adding the new product or service as a profit center, instead of it being a huge investment risk that you have to take on at the beginning. The next one that I see as being a really useful method when you're doing acquisition of a competitor is geographical expansion. And I was actually having this conversation with somebody just yesterday, because the challenges with opening overseas offices. So, we saw this in a company years ago where they were from Australia. They did some business in America, but they launched a company in the UK. And of course, they had to start from scratch, and they knew nothing about the UK landscape. They didn't even know how our VAT, value-added tax like GST or sales tax. They didn't even know how the sales tax was calculated and reported in the UK. So they become heavily reliant on really expensive advisors and things like this to try and deal with some of these issues. So, when you go through that baptism of fire learning curve, I had a business in France, you can't fire people. Had a business in Spain, you can't fire people. So there's all sorts of different countries have different rules you need to understand pretty quickly. But if you buy an existing business in that country that already has an office, already has staff, already has a website, already has customers, you can add more to it. You can start to deliver your products or services through that office, and they'll just know what to do. It's what they do all the time. You've got the team, they're already delivering it, and you don't have all of that kind of startup cost or really high cost of professional advisors in order to be able to launch yourself into that new geography. So you want to open that New York office or that Tokyo office or that London office. You can do it with an acquisition instead of being a massive suck on cash flow resources and all the risk that goes with it. The next one is the one I described right at the beginning, which is moving up the scale pyramid. The bigger you are, the more valuable you become exponentially. So not just in linear terms, but in exponential terms, your value increases. So there is a huge benefit in just growth, just being bigger, because you become rarer and you open yourself up to a wider audience of potential buyers. And so again, what most companies find is that there is a plateau or glass ceiling that they can reach. And it seems very, very hard to break through that and get up to the next level, often because the dynamics of the team and everything have to change in order to jump up to that next level. But when you do an acquisition, when you have a sister company sitting alongside you that's feeding the same profit and loss and balance sheet, you can make that massive leap. You can double the business or triple the business in a single transaction. And I don't know another way that you could double your business in the next couple of months other than with a merger or an acquisition. So I think, it's a very powerful, often overlooked tool. And I think the biggest place that people get stuck is they assume they need tons of capital and tons of experience to be able to do it. You absolutely need to know what you're doing, or you can have a huge disaster. You should never borrow money to buy businesses, and you should never put lots of capital at risk in a transaction. But just like anything you want to achieve in life, if you know what you're supposed to be doing, you take the action, and then you do it on a consistent basis, you will succeed. So I actually wrote a book called War, which now seems oddly appropriate with what's going on in the world. But it's nothing to do with war. The title of the book is War, How to Do Everything, or How to Do Anything, actually, sorry. And basically the idea is that the W is wisdom. You need to know what you're supposed to be doing. The A is action. You need to get off your ass and do it. And the R is repetition. You need to do it consistently again and again and again. And you can apply it to, let's say, health and fitness. So with health and fitness, you need to know what exercises to do, and you need to know what types of foods to eat. You then need to take action. So instead of saying, oh yeah, I'll start on Monday, you need to start now. Even if you don't feel ready, you need to start before you're ready. Then you need the repetition. You don't get fat from one pizza. You don't get thin from one salad. You need to continuously apply the rules in order to succeed. It's the same in business, and it's the same in M&A. And in M&A, the wisdom part comes into sharp focus because most of the wisdom out there and most conventional wisdom is actually wrong. So a lot of the books and a lot of the websites are produced by advisors. So their advice is, of course, get loads of advisors. It's like going to a hairdresser and asking if you need a haircut. They got one thing to sell you. And of course, all the MBA courses and the kind of business degrees and things where they talk about M&A, they're always analyzing some massive mega deal where, the world's largest brewer bought the world's second largest brewer. And we can literally learn nothing from that transaction that would translate in any meaningful way to how you deal with an owner-operated business in your local town. So you really getting the wisdom right is really tricky. The other thing that's made the wisdom bit a bit tricky is that there's been a whole bunch of fake gurus in this space. So I started a community called the Harbour Club back in 2009, really to address demand that I was getting from people that wanted me to come and work for them. So people were always coming to me and say, could you be a non-exec? Could you be a consultant? Can you, come and help us buy companies? And I was just used to think, well, why on earth would I do that? If I find a company, I'm going to buy it myself. Why would I buy it for somebody else and give them all the upside? And so I created the Harbour Club as a community for those people to join, where they could learn how to do these owner-managed deals. I could be proud if they went on and did one, but I wouldn't actually have to do the work for them. I would just show them how to do it, and they could go out and do it. That started in 2009. It's gone bananas now. We did $1 billion of deals in 2000, $1 billion of revenue worth of deals in 2025. We've done hundreds of millions of dollars of exits. It's got nearly 2,000-3,000 members around the world. There's a really active community and app. We do live events. There's a whole bunch of stuff that kind of span out the other side of that. I now do probably 50% of all my deals come from the Harbour Club. So it's with Harbour Club members. So I have this amazing pipeline of opportunities that comes from having that community. And it's really it's a really vibrant and an exciting place. But it's also taught me loads and loads of lessons, and it's really helped me kind of hone my skills as well. And taught us how to do things. So the Harbour Club community is a great kind of central point to get that wisdom bit done. Now, what happened is after I launched that, all the people that were selling social media courses and selling real estate get rich quick things and FX trading get rich quick things, they all suddenly became M&A gurus. If you read their profiles on LinkedIn, it would say something like, for 30 years, I've done nothing but M&A. I'm an M&A expert. I've never done anything else apart from M&A. It's in my blood. It's, all I've ever done. And then you'd look at their, recommendations on LinkedIn, and it would be for social media, FX, trading, completely different topics. But unfortunately, it did muddy the waters, because if I say, I've taken nearly 100 companies public, I've done a couple of hundred transactions on my own, I've advised on hundreds more, I've been doing it for 30 years, they would just copy that and put it on their profile. So their profile now says they've done 30 years of experience and hundreds of deals. But the difference was theirs was just made up. So it really created a lot of mud. And unfortunately, what they did is they just took a lot of textbook content and republished it. And of course, that doesn't really teach anybody anything. So you end up with the blind leading the blind. And all they're really interested in is trying to sell you more training. Whereas they copied the wrong thing. The thing they copied was teaching people how to buy businesses. Actually, the money is in buying the businesses. Teaching it does give you good deal flow. But yeah, my upsell isn't a mastermind course. It's a $10 million deal. So they definitely copied the wrong thing. But of course, they don't have the experience or knowledge how to put that $10 million deal together. Now, fortunately, about half of them have disappeared now. So particularly a couple of the American ones who are particularly noisy are now AI gurus who've only ever done anything to do with AI and have been AI gurus for 30 years. So they've completely repositioned everything to be AI gurus, having been M&A gurus for the last few years. And prior to that, digital marketing gurus and so on and so forth. So AI has been a bit of a blessing in that respect, that it's filtered out some of that crap. But the W, that wisdom absolutely is is critical to know what to do, because you can be a really busy fool going down the wrong rabbit hole. You know, the most common thing I see is people Googling buying a business, and then they get sucked into the buying business websites and the broker community. Now, the brokers hate us because the worst thing for a broker is an educated buyer, and we have a whole business that is built around educating buyers, and so consequently they say nasty things about us, but they really don't add any value to the world, or particularly the M&A world. So we're not particularly bothered that they don't like us. We just get on and keep buying businesses. So yeah, and ignore the noise. But yeah, brokers don't like us. So wisdom is really critical. Understanding what you're supposed to do in what order is really critical. The next one is action. You know, doing something. Now, I've trained thousands of people how to buy businesses, and I used to try and pick winners. You know, I used to look at who was on a course and think, yeah, that guy's going to nail it. That girl's going to be really good. Him, I'm not so sure. You know, I try and judge people, and I was always wrong. I was spectacularly wrong in a few cases. And what I realized was the differentiator isn't your ability to communicate. It isn't your intelligence. It isn't your understanding of the deal structures or your experience in business. The differentiator was action. The differentiator between the people that were successful and the people that weren't were the people that actually did something right now. You know, so for example, there are hundreds of people in your phone that you haven't spoken to for ages, that if you knew, you know, if you decided you're going to buy a competitor, and a competitor for you, was artichoke farmers. If you just rang everybody in your phone and said, hi, how have you been? You know, what have you been up to? And talk to them, have a chat, have a catch up, and then point out that you're looking for artichoke farmers. You'll be amazed by the time you got through a bunch of those phone calls, how many artichoke farmers you would have as potential targets to go after. You know, absolutely, people find your next deal is probably in your phone. And what people tend to do is they judge, they look at their phone book and they go, oh no, they won't be any good. Oh no, they won't be any good. Ring them anyway. You'll practice your pitch. You'll practice having a chat. You'll chat to someone you haven't spoken to for ages. You never know what else comes out of it. It's the best networking you can do. Why go meet new people when you can speak to people that already know you? It's a much better approach, and you'll be amazed how many opportunities in there. So, you know, that's an example of taking action. There's several things that you can do on day one that are, you know, that would be taking action. But by taking that action, you'll be amazed how the fucking universe just aligns and gives you things after that. So if you want to get all woo-woo about it, it's you know, you really do get out what you put in life. And so yeah, making sure that yeah, you let people know what it is you're trying to do, and then people can actually try and help you. But if they don't know what you do, then there's no way they can help you. So that's the action side. Then there's repetition. The other thing that I see people do is they go nuts for a week and then they stop. And this is the same, going back to the health and fitness analogy. You know, you decide you're going to get fit. You decide you're going to start Monday, because, you know, why start today when you can start on Monday? And then you have 9 burgers before you start. And then when you do start, you go to the gym, you run a marathon, you do your 10,000 steps, you climb a mountain, you eat 1 lettuce leaf, and then the next day you feel like shit, and you drop off the edge again. And so you have this huge spike of activity, and then everything goes back down to zero. And I see this in M&A and business a lot as well. People come back from a seminar and they're all full of beans, or they come back from just a brainstorming session with themselves and they're really fired up, and they take all this action and then it stops. So it's this kind of feast or famine approach. Whereas actually, if you just did something small every day, over time, the compounding effect of that would be enormous. So if you just keep, you know, sending out letters, reaching out to people on LinkedIn, calling people in your phone book, and just do it systematically, you know, day in, day out, a little bit of activity every day. And then that activity will compound and compound and compound, and then you just see results just fall out the other end. And we've got so many case studies of Harbour clubbers that have gone through exactly that process, that when they just start putting the effort in, they just start getting the results consistently. So yeah, it's a really good kind of framework to follow. So wisdom, action, repetition, and then just keep repeating, 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 and you'll find that, yeah, like I say, over time, those activities compound and you do stuff. So when you're buying competitors, what's the starting point? Well, the starting point is to understand what is, because I say competitor, but it's in a very loose term, what are the companies that you would like to acquire? So the first thing to do is think about the business that you have now and think who are the direct competitors, the horizontal acquisitions. So the people that are the same as you are. So if you're a estate agent or real estate agent, then a horizontal acquisition would be other real estate agents that you could add alongside you, which might solve the geographical problem, might solve a whole bunch of other things. Once you've made that list, who are all the horizontal opportunities, then think about what are the vertical opportunities that you could integrate into a real estate business. So could you add a lettings agency? Could you buy a property management company? Could you buy a facilities management company? Could you actually buy the people that deliver those services, like the electrical contractors, the mechanical electrical engineers, the heating, ventilation, and air conditioning companies, all of those types of businesses. So think about what are the vertically integrated acquisitions you can do. So you've then got a list of all the types of companies that you want. Then think about the geography. So are these businesses you want to go and see on a regular basis, or are you adding them to a bigger, wider group? Are you going to use it to consolidate your regional footprint, or are you going to use it to geographically expand? Are you going to expand internationally? Are there businesses in other countries that you think would be beneficial to add to the pot? So start to think about what the total universe might look like. And then the big mistake that people make from this point is then trying to find the ones of those businesses that are for sale. And you don't want to do that. In fact, you want to do the opposite of that. And you just want to find all the companies that are in those spaces in those geographies. So, if you've decided I'm going to focus on the southeast of England, and I'm going to focus on estate agents, letting agents, property management companies, and facilities management companies, then just find out all of the companies that fit that profile in that geography. Now, again, next mistake people make is they go and they use company house data. So companies house data, and forgive me if the audience is not very UK centric. I'm using UK examples, but there's examples we can use in lots of other places. We do lots of deals in Australia, New Zealand, Singapore, the UK, the US, Canada, mainland Europe, etc. But in the UK, people tend to use this company's house data. So it will be something like Endole or one of those portals that taps into that company's house data. And unfortunately, that extracts all of the business type by SIC code. And the SIC code is the code you select when you first form the company. Now, most people form their company and then decide to do something completely different with it and never change the SIC code. So you'll often find that the list that you have won't include all of the companies that are in that space, and probably a good percentage of the companies it does include aren't in the space that you actually want them to be. So as well as having that company's house data, you do need to look at some other data. Now, you can buy lists, which lots of people do. You can buy a list and then you can use Endole or one of these companies' house resources to find out more about the company, like the directors' names and service addresses and things like that. You can use a trade association. So let's say you're buying window fitting companies. There's probably an association of window fitters. It won't have all of them in there, but it will have a really good collection of them. The other thing that works quite well is directory services. So things like Yale.com or Business Search Pro, which is by Thompson's. So basically that will give you, that'll give you a really good selection of businesses, because people get their directory entry correct because it might lead to future business. So whereas it doesn't matter what it says on Companies House, the directory entry tends to be right. So shortlist all of those companies that fit the profile of the type of companies that you would like to acquire. And then the next step is just to focus on speaking to the owners of them. So your goal should be every week you're speaking to the owners of the kinds of businesses that you would like to own. Now, no agenda. You're not trying to buy them. You're not trying to invest in them. You're not trying to do anything. You just want to be doing basically a fact find and finding out what their thoughts are on the industry, what their plans are for the business going forwards. If they're open to the idea of, a merger or roll up, or if they're thinking about acquiring other competitors at the moment, what do they see as the opportunity? You're more or less finding out from them where they see the opportunities and threats and weaknesses in their own industry, with a view to you potentially doing something collaboratively together. And then once you start to do that research piece, you'll start to see the stars line up in terms of deals that you can get done. So these are the ones that want to exit. These are the ones that are going bankrupt. These are the ones that are actively trying to acquire everybody else. So you'll have a really good feel for the kind of movers and shakers in the space. And then after that, it's really getting on to deal structures. So yeah, there's a really long topic on deal structures. So there's a couple of resources I want to open your eyes to. So the first one is we have a 21-day email course that's completely free, where we send you an email every day for 21 days, and we take you through how to source opportunities, how to hold the meeting with them, a couple of deal structures you can use. I mean, we have 15 on the Harbour Club, but we go into a couple of them on this 21-day course, just explaining how you do a no money down deal, then what to do once you take over to add value immediately, and then how you sell the business. If you want to get that, you just go to harbourclubevents.com, and it's Harbour as in my name, so it's spelled Harbour, harbourclubevents.com. Go to that website, you'll see free course. There's a little tab up in the top menu bar. Click on that, put your details in, and you get that email course come through. That will give you a really good kind of framework of the types of things I've been talking to, and a couple of deal structures that you can go out and use in anger. Now, we also have a lot of people that are quite early stage in M&A, so they're not ready to do something like the Harbour Club, which is really a full-blown M&A approach. It's a full-blown community course and everything else. And look, the Harbour Club is an amazing solution if you're thinking of buying a business, because you can spend 20, 30 grand on legal fees not buying a business. So the Harbour Club will absolutely, if you're not paying for the Harbour Club, you're paying for it anyway through not having the experience and knowledge that you would get from it. And if you do want to find out more about the Harbour Club without any obligation whatsoever, just go to bookhc.com. So BOOKHC.com. Go to bookhc.com. Calendly link comes up. Click on a time and have a chat with one of our team about how it works and what it does and all of that sort of stuff. If you're not ready, we also have Deal School. And Deal School is free for 7 days. Tons of content in there. Loads of interviews with me. Loads of Q&As that I've done with people. There's a whole course on one deal structure where we really go into depth about how you do one particular no money down deal structure. There's a whole section on wealth. There's loads of stuff. So if you're not familiar with the School platform, it's SKOOL. So if you just Google the School platform and look for Deal School, you'll see it in there. So it's the Harbour Club Deal School, or the Jeremy Harbour Deal School. I don't think we use the Harbour Club branding for it, but yeah, it's free for 7 days, and then it's not that much on a per month afterwards. But you can consume a lot of content in the 7-day free session, and then decide if you want to do more with it. So yeah, hopefully those resources give you some ideas to kickstart. So fire away with any questions. I can see there's one in the chat already and one in the Q&A, so I'll just address those. So probably you've been asked this question thousands of times. What would you do today to start acquiring a company in the next 90 days? Yeah, great question. And look, it's really what I was describing in terms of getting the wisdom bit right. So what is it they say? If you've got 4 hours to chop down a tree, spend 3 hours sharpening the axe. So if you've got 90 days, I would spend the first bit of that really making sure that you understand what to do. So the 21-day email course, dive into all the free content that we provide, and get yourself as up to speed as possible. And then just start the outreach. You're never going to feel ready, so you're going to have to start before you're ready. So yeah, get out there and start speaking to business owners. It will really help with your own development to have a few conversations with people. It's the way I describe it is you can read loads of books about playing tennis, but nothing's going to beat picking up a tennis racket and a ball and hitting it around the court. So get to the practical element as quickly as possible. So a question in the Q&A. If you're industry agnostic, how do you construct a narrow enough acquisition thesis to begin outreach to target companies? Yeah, so I am industry agnostic in terms of we do stuff in loads and loads of different spheres, but we always do that in partnership with someone who is an expert in that particular industry. So we don't just go blindly bowling into a completely new area unless there's somebody that we're with or somebody that's in the business that's going to be our expert. I always recommend people when they're starting, you basically need to remove the obstacles that sit between you and doing the deal. And one of the biggest obstacles is the empathy and rapport that you can build with the business owner. And one of the best ways to get empathy and rapport is through credibility. And one of the best ways to get through credibility is knowing what the fuck you're talking about. You might be industry agnostic, but there's probably some areas where you sound like an expert. And sounding like an expert, knowing some of the industry inwards, knowing some of the people in the industry, the villains and the heroes of that industry, that will help with that credibility creation enormously. And that credibility creation will help with the rapport and empathy that's needed to get the deal closed, particularly your first one. Your second one, you can leverage your experience to close it. So the industry experience then becomes less important. But it's still an obstacle. So if you want to remove the obstacles, better to focus on a list of things you're really good at. Figure out the things you're really good at and make that list and focus on those first. It's kind of the low-hanging fruit to do the stuff that you're experienced in. Now, some people come to me and they go, "Oh no, I don't know. I haven't got really any experience of one particular thing." And actually, then when you analyze it, there is something that you know a lot about. It might even be a hobby or it's a business that you don't necessarily do anymore, but you understand a lot about it. So let's. Next question. Great talk. Thanks, Jeremy. Do you have a view on post-acquisition plan to drive efficiencies? Yeah. So the biggest lesson I've ever learned about post-acquisition efficiencies is don't implement them. What I mean by that is if you acquire a company and then immediately start telling them the things that you want to do, like getting rid of this person, closing this office, making these changes. I found particularly in small businesses, you get this resistance from them, which can be very detrimental to the business, even to the point where you can put two companies together and end up with less than one was doing by the time you finished with your integration. And for me, it was quite a hard lesson to learn that all that stuff you put on paper doesn't really translate terribly well once you bought the business. However, when you buy a company, effectively, people kind of imagine they're being merged together in some way. They're really not. They remain completely separate, completely on their own 2 feet. You just have a common holding company that owns the shares in both companies. So they are isolated from each other to an extent. And so what you can do is then incentivize the management in those companies to find those efficiencies themselves and to go and implement them. So you normally do that through some kind of brainstorming session where you get them to come up with the ideas and you get them to come up with the execution. Because what I found is if it's your idea, it's terrible. And they will even go so far as to sabotage it to prove to you it was terrible. Whereas if it's their idea, they'll implement it with vigor, and they'll even go so far as to put their own hand in their own pocket to pay for things to prove to you that it was the right way to do it. It's astonishing human psychology, how people behave. But yeah, basically, if it's their idea, they'll make it work, and if it's your idea, they'll make it fail. Is the lesson that I've picked up. And I know I'm sounding very cynical, and I'm a lot more cynical now than I was when I was younger. but yeah, my experience of those post-acquisition efficiencies is make them do it. Let them be the masters of that. It also stops you from getting this kind of deal indigestion. So I used to dive into the business and spend all my time in it immediately after buying it. And actually, that's not healthy either. You're better off looking for the next deal and getting the teams within those businesses to solve the problems. So it can work really well. You mentioned earlier that one should not spend much cash on acquiring business. So would the Go model be all stock deal? No, there's 15 different structures we use for acquiring companies without any money. I mean, there's loads of them. So you can do an all stock deal, which is what you've described, which is basically a merger or reverse merger. That obviously works much better in a public company environment where the stock has a demonstrable value and is priced by the market. And we've done a lot of those kind of deals in the past and learned a lot of lessons about doing those kind of deals, which we share on the Harbour Club. There's all sorts of innovative things that you can do. You can use listed bonds where you issue them with bonds to acquire their company, and then the company can have a repo program that buys the bonds back, so they don't have to hold them all till maturity. They actually get some cash every month out of the business. You can use deferred payments. You can use a number of different structures. A really common strategy that Harbour Clubbers use is something we call a WIBO, which is effectively like a sweat equity position that you take, followed by a deferred acquisition of the balance of the company. And when you put those two things together, it's really very powerful, because it's often hard to get somebody to commit to 100% of the company deferred, but to get them to commit to 20 or 30% for a demonstrable impact to their business is quite easy to sell. And then coming back for the rest of it later is just a much easier proposition. Basically, it's kind of the how do you eat an elephant one mouthful at a time type of approach. So instead of trying to do it all in one bite, you do it in two bites. And what's interesting is you can normally get the 2 bites completed within a 12-month time frame, which is about how long it would take you to do a leverage buyout where you're borrowing money from the bank, because the bank will be 2 weeks away for months and months and months while they go through the due diligence, and it's extremely painful, and it will cost you lots of money up front, and the deal might fall over on at any moment. So it's a lot more resistant in that respect. So we're pretty close to the time here. So if anybody wants to fire any last questions in, they can do. I'm just going to pop in the chat the links that I mentioned. So bookhc.com. So this is, it's added to it. It thinks I'm spelling it wrong. Bookhc.com. So click on this if you'd like to have a chat to any of our team about becoming a Harbour Club community member. This is the big grown-up place to be. It works. It's an amazing community. You'll find some really cool people in there. And then the other one is to go to Harbour Club events.com. I think I've got that right. Yeah, harbourclubevents.com. If you go on there, you get the 21-day email course. Now, our 21-day email course basically is better than most of the paid courses that other people are peddling out there in the big wide world for sort of $2,000, $3,000, $4,000. So don't go and waste your money on one of those blind leading the blind guru things. Just do this. Just do this one. It will give you more than you get from those other guys, and for free. The Harbour Club community is next level. That will be live events. We have an event in December called Deal Fest, which is 3 days of case studies. So I think we had 30 presentations last year from Harbour Clubbers, basically taking you through deals that they'd done, and what they'd learned from them, warts and all kind of information. So that's an event everybody looks forward to. So, are there any final questions, or should we wrap it up? There? Do let me know if there's anything left. No, getting lots of love, but no questions. So, I think that was a really good session. I covered all the bits I wanted to cover, and look forward to seeing you all at a Harbour Club event or something soon. So, thank you very much.